Hello everyone, my name is Monica and I'm excited to be here today to present to you insights from industry experts who participated in TradeTech Europe 2023. As we all know, the financial world is a constantly evolving industry that requires staying up to date with the latest trends and technologies. This is why events like TradeTech Europe are so important. This year we've been joined by over 100 speakers covering a wide range of topics, from macroeconomic drivers of equity investment to cutting-edge technology driving the execution landscape. In this video, we've compiled some of the most insightful and thought-provoking moments from the event.
TradeTech, as usual, has been a great opportunity just to hear the pulse of the market, and what we're hearing time and time again is liquidity is the real challenge that people are facing. We know from our own studies and from what people are telling us that liquidity continues to be a challenge, finding everywhere from block trading right through to how to arrange their algorithms and how to find alternative sources of liquidity. We know from our own report that while in March there was a spike in volatility and liquidity went up, generally Q1 was a continuation of the trend that we've seen in European markets for the last 2 years of lower volumes, less conviction, and a lack of appetite in equity trading in Europe generally.
What we're seeing is that customers are getting more and more concerned about not just managing risk locally or on a single market, but they're trying to manage their risk globally across multiple markets, multiple order books, multiple different trading venues, but in a coordinated manner.
I think the big difference that we're hearing this year, and it's a continuation slightly from last year, is the growth of market making and the change in the way that risk capital is being distributed across the market. Traditional risk provision by banks, it seems to be drying up. Although SIs are traditional risk platforms, they are waning in popularity in some ways, and people are going more direct to the alternative market maker providers, the likes of Optiva, Jane Street, Flow Traders, etc. These firms seem to be growing an appetite within the market to provide risk, and we're seeing things through things like RFQ platforms coming into single stock equities, how they could potentially help with that risk capital distribution.
Two of the major technology shifts that we've seen in the market and requests that we've received from our clients. One of them is the end customers are starting to ask for control over their data and access to the systems that the brokers are using to access the market. So for the first time, we're seeing this concept of brokers opening almost a multi-tenancy environment, allowing their clients to control their own trading flow within the trading platforms.
The employment of data science into the market data business has been one of the key enablers for us to start providing more analytics. So to ensure that the client has to do less of the heavy lifting on their end, we are building up our data science capability, some of our tools, AI, machine learning capability, to ensure that the client doesn't have to do so much of the heavy lifting on their end. Although you get clients on both ends of the spectrum, so some clients like a raw data feed and they have all the in-house capabilities to do all the number crunching themselves, they also get the client on the other end of the spectrum that doesn't have internal enablement. And we want to be able to serve them as well.
For us, the other really big technology shift that we've seen on the agency broker side is there's definitely been a move away from specialist quant departments in banks. For them, the future of the trading marketplace is the ability to put controls over trading flow into the trader's hands. A quant trader is a new concept where people on the trading desks are not just responsible for executing the trades, but actually engaging directly with the end clients for designing how the execution algorithm will behave. The tools that Quad is trying to provide to these customers are really trying to innovate in ways that the traders themselves have the ability to both fulfill a quant role as well as a trading role, meaning that they can respond to customer requirements in real time, even over the phone, making changes to execution policies and algorithms. It's this merging between the trading desk and technology that's really an innovation that's fundamentally changing the way that clients are interacting with their agency brokers.
Many people you hear in the industry, especially buy sides, complain about regulation, but when they complain, I try also to tell them that it's an opportunity for them and for the whole industry to have better knowledge, better metrics, especially around best execution and TCA, smart order routing.
We've seen over the last couple of years, Monica, that trading is getting more and more complex. We have seen a significant fragmentation when looking backwards, something like 10-15 years. Trading was pretty much concentrated on primary exchanges, and with the implementation of MiFID I back in 2008, but also MiFID II, led to a further increase of complexity. It's something we can cope with extremely well. So technology is really key in combination with highly sophisticated traders.
It's quite interesting you ask that. We had a conference at the London School of Economics Systemic Risk Centre 2 or 3 weeks ago, and one of the subjects we talked about was the fact that the report that was the 10th anniversary, we were celebrating the 10th anniversary of, made a load of recommendations that then got passed into the EU finance function, and some of which formed some of the inputs to MiFID II. In having that discussion with some of the regulators in the room, with some of the banks involved in the room in the negotiations, I felt that we need to, as an industry, have more input into the final stage of regulation, because we asked the question about a few areas. How did this recommendation end up getting implemented like this? And what we found was that it was purely a political negotiation. If you look at a bigger industry such as the airline industry, when Boeing had the MAX grounded, what we found was that Boeing actually had so many people briefing the FAA on such a consistent basis to make sure they really understood the science and the engineering implications, that the FAA gave them an office in their building. We need to have that sort of level of engagement with the people making the rules, so that we get the regulations right and we're not doing things like revisiting double volume caps to get them back closer to the original recommendation, because the double volume caps ended up being a piece of political negotiation in their final implementation.
The regulatory side continues to be evolving this year. We've got a lot of regulatory change that's going to happen with the MiFIR review, the FCA wholesale markets review. It's going to be interesting to see how ESMA implements some of those changes, because they could have quite seismic changes on the way liquidity forms within the market. Dark trading, it seems to be continually in the focus of the European regulators, less so in London. So how that divergence plays out later in the year is going to be interesting.